Wonderful piece in Bloomberg Opinion in the last 24 hours. You're exploring whether we're losing an anchor. Are we losing an anchor, Mohamed?
Good morning, Jonathan. Thank you for having me. It is certainly less powerful, and let me explain. We know that for quite a while, fundamentals haven't been a determining factor, but liquidity has been. And there's been two engines: the private sector liquidity, new investors getting involved, and then the support of the Fed, which has been incredibly consistent. On the first one, we've seen it evolve from being a market-wise phenomenon to being very name-specific. So everything falls now on the second one. And what we've seen since Wednesday, since the press conference in particular, is that people are less comfortable about the effectiveness of Fed liquidity. And because of that, some people are more willing to challenge what Kayleigh rightly said are pretty elevated valuations.
Mohamed, on the Fed, though, in that news conference, I was trying to work out what everyone was upset with. In your piece, you talk about the specificity that they went through around rates and the vagueness around QE. Is the latter really that confusing ahead of an election just a couple of weeks away?
It is for markets looking for clear evidence. There's a piece out by Greg Ip that notes that it was all about verbal guidance. It was all about using the word powerful 10 times in the press conference to convince investors that liquidity injection remains ample and reliable. But when investors looked at details, they said, okay, so I understand you're very specific about your interest rate guidance all the way to the end of 2023, but what about your QE guidance? Because, John, what happens when interest rates are floored for a long time, the delta you get in terms of impact diminishes. But QE is a repeated influence. So that's why the marketplace was disappointed not to hear more about the QE plans.